You're live now.
Interesting.
Yes. Excellent. Well, we've got quite a few people joining. And we'll give it 2 minutes before we start the session. But welcome to everybody that's with us today. Thank you for joining. We are expecting quite a large crowd today, and our topic is quite popular. We will be talking about some estate planning matters, which is becoming a very hot topic in today's age, since now that we've come out of COVID. For those that are actually accountants or have run a business, this is a very, very important session. Hazel is an expert on estate planning matters. Hazel, for those who don't know Hazel Johnson is our tax director. She's a barrister, she's a lawyer, she's an estate planning expert, and we're still on air? Yes, we are. So Hazel can advise, has been advising a lot of clients previously, historically, and very, very wealthy clients. She's advising quite a lot of wealthy clients currently. Hopefully this session will be very much enjoyed by everybody.
Okay, shall I shall
Yes.
start.
Yes, just make a start, and then hopefully people will join.
So Churchill Tax Advisors are a specialist tax advisory firm based in London and Essex, and we have national coverage, and we deal with all sorts of tax, income tax, business and inheritance tax planning. And inheritance tax planning is mostly what I'm going to be talking about today. So broadly, what I intend to talk about is a background to IHT, to talk about wills, gifts out of income, and also business property relief, and talking about tax planning also for UK landlords. So as a bit of background to inheritance tax, inheritance tax is generally charged at 40% on your estate on death above a nil rate band of £325,000. A transfer to a spouse is tax exempt, and you have what is called a transferable nil rate band. So if you die and you haven't used your nil rate band and you leave your assets to your spouse, on their death, they are able to use both their nil rate band and your own nil rate band. And in the case of the main residence, there's what we call an extended house nil rate band, which goes up to £500,000 per spouse. Although it must be borne in mind that that is limited where the value of the estate is over £2 million. And there can so you lose relief as your estate becomes increasingly valuable. So the primary sort of method of doing inheritance tax planning is a will, and everybody should have a will. I think the sort of statistics are that about sort of 60-70% of people really haven't got a will. And a lot of people sort of expect that when they die, everything will go to their spouse, or in some cases, if they die, everything's going to go to the person that they're living with, but they're not married to. And that's not the case. Now, as I said, there is a spouse exemption, which means that any bequest made to your spouse would be tax exempt. And that's useful for avoiding tax on the first death. But what that does mean is you bunch the estate in the estate of the survivor, so that inheritance tax will be quite chunky on the second death. So one of the basics of sort of inheritance tax planning is to make sure that if there are assets in the estate which are what we call tax privileged because they're exempt or taxed at a lower rate, then you should pass those to your children on the first death, so that the estate is not bunched up in the second, in the surviving spouse. You would normally aim to have the family home dealt with by virtue of the extended nil rate band, although you may want to consider downsizing depending on what stage you are in life. And if you have minor children, it's particularly important to have a will to make sure that their interests are being looked after. Who is going to be their guardian? Who is going to look after their financial interests going forward? And it should also be borne in mind that when somebody has died, if the will doesn't deal with things in the most tax efficient way, it's possible to revisit that with a deed of variation, provided you deal with that within 2 years after the date of death. And at that point, you can rewrite the will, and that rewriting will take effect as if it had happened on death, both for capital gains tax and inheritance tax purposes, but not for income tax. So you could have what you would call a backstop will and leave everything to your wife. And then when somebody dies, you can then look at the will, revisit it, and decide that on the basis of the estate as it is at that point, it's more tax efficient to do something else and rewrite that will to give a better tax effect. But you should also be giving thought to doing potentially exempt transfers during lifetime. And provided you survive 7 years, then there's no charge on death after those 7 years are over. And of course, lots of people come to us wanting to do tax planning where they essentially give things away for the purposes of inheritance tax, but still want to enjoy those assets. And there are a set of rules that are designed to stop you from doing that, a gift with reservation. So that if you say give away the family home and still live in it, that would not necessarily be an effective gift for inheritance tax purposes. So you have to be very careful about that sort of thing. You can make small gifts. There's an annual exemption of £3,000, which allows you to make sort of small gifts to members of the family that are not going to be caught by inheritance tax. But one of the things you could also consider is what we call making gifts out of income. So inheritance tax is primarily a gift on capital, is a tax on capital. So if you make a transfer of capital to your children, then that's going to be a potential exempt transfer. But if you make a gift of income to them, that is not, and it's outside the inheritance tax regime. To fall within the gifts out of income exemption, it has to be regular. You have to be able to make gifts that are going to maintain your standard of living, so it's not going to touch your capital. And you have to evidence the intention that this is what you're going to do, both to the regularity and that you've maintained your standard of living. One of the most valuable reliefs is business property relief. So you then have to look at whether the business that you're considering is a trading business. And in the case of landlords, that's not going to be the case. Although it's a business for corporation tax purposes and indeed income tax purposes, it's not for inheritance tax purposes. So when you're looking at a company, it has to be trading as to more than 50%. And that can be, depending on what sort of business we're talking about, that can be either turnover, the time spent in the business, or profits. And sometimes those give you the same answer, so it's very clearly a trading business, but sometimes you spend a lot of time and energy generating turnover, but the profits can be very low, and you have sort of investment assets that are generating more profits, and vice versa. And in that case, you have to consider your position carefully and think about how you're going to make the argument to HMRC. And one particular point of pressure is looking at sort of what they call investment assets. So that can be premises that you own. Maybe you originally used them as part of the trade, but now you're renting them out because it's more profitable. Or if you've got lots of cash balances. I mean, certainly in the context of COVID, HMRC have said if you're retaining cash balances as a sort of a cushion against hard times, that's not going to be an asset that you're using in the trade. You're not holding that for a trading purpose at all, which is not very helpful at all. But if you can show that you've earmarked that cash for, say, a future trading acquisition, you're going to buy new premises, you're going to buy new machinery, then you can then run the argument that that cash, although it should be normally viewed as an investment asset, is in fact a trading asset. Even if you then have got to the point where you can show that 50% of the trade, 50% of the activities of the company are trading, and so you qualify for 100% business property relief, the question then is how much is that relief going to be applied on? And they have this concept called accepted assets. So what you do is you strip out the value of investment assets in the company, and then you apply 100% relief on it. So if you have a company that's 70% trading and 30% investment, you would then only apply that 100% relief to 70% of the value of the company. And so it's vital that you have got enough documentation, you've got detailed accounts, and you have detailed notes of the purposes for which you're holding any cash balances, and a sort of a business plan that shows how you are trading, why you are trading, and how you anticipate the business going forward. And in that case, in the case of death, or if you're making a lifetime gift and claiming business property relief, you will be able to demonstrate that you are in fact holding shares in a trading company and entitled to full relief. The point about landlords is that buy-to-let is not a trade. As I said, for corporate tax purposes, it can be treated as almost a trade, but for inheritance tax purposes, it is not, unless you're doing something radically different in the way you manage your business. So if you're just effectively managing a buy-to-let business, that's not going to be a trade. If you're providing additional services over and above just renting out the property, then it is possible that you might be able to argue it's a trading business. But the benchmark for that is very, very high. So if you're a property investor and you've got a portfolio of more than £1 million, you're going to need specialist advice on how to do lifetime giving. If you hold on to the assets until your death, you're going to be paying 40% inheritance tax. If you give away your assets, you have to survive 7 years from the date of that transfer to avoid an inheritance tax charge, but you're also going to have to pay capital gains tax on the gift, and potentially you've got stamp duty, land tax exposures for the recipient where you're dealing with a mortgage situation. However, there are structures that you can use to pass on wealth. So there are things like family investment companies. So these are structures where you have different classes of shares for each member of the family, and that allows you to pass wealth between members of the family to give, younger children initially a small share in dividends, but perhaps increasing over time as they gain age and maturity and are able to participate in the business. And you can do the similar thing with partnerships, where you can use a partnership structure to both transfer wealth between generations, but also to retain the ability to receive income from your property portfolio. We also have people coming to see us to talk about trusts and foundations. And although there's generally a perception that this is going to give you lots of inheritance tax savings, trusts are generally not a good idea, other than occasionally in a will, to protect minor children. Generally, if we're talking about trusts in a lifetime context, they are very expensive to set up because there's a 20% upfront inheritance tax charge, and they're not generally effective about passing on assets out of your estate, because if you retain an interest in them, then you will be treated as having a gift with a reservation of benefit, and it's still treated as being in your estate on death. They're also taxed very poorly for income tax and capital gains tax purposes. And the same applies to foundations. Foundations are sometimes treated as trusts, and sometimes they're treated as companies. And normally that leads to having the worst of both worlds. So unless you have some sort of offshore connection or you're non-resident, a foundation is unlikely to be very helpful for you. So in summary, and to give people time to ask questions, broadly, your approach when you're sort of thinking about doing inheritance tax planning is to consider will planning first. You need to make sure that your will is up to date and it deals with your current situation. There is a basic format for a will of just leaving everything to your spouse and then sorting it out later on death, just as what we would call a backstop will. But it's also possible to do a more complex will, and we can advise on that generally, where you're doing a more sophisticated division of assets between spouses and children, and dealing with the interaction with lifetime planning. And lifetime planning is going to be a combination of making gifts before, at a time when you're young enough to anticipate living for the next 7 years, or putting your assets in such a state that you're going to qualify for whatever exemptions, and doing a necessary review of your structures to make sure that that's the case. And these should be regularly reviewed to deal with any changes in your life. You know, if one of your children has a new grandchild, is your will going to deal with that properly? If one of your children gets divorced, do you need to change your will? If you've given away some assets, again, you may need to change your will. If your wealth has increased, you may need to look at your will again. And as I say, in the context of people who have got businesses that don't qualify for business property relief, and generally we're talking about landlords here, they're going to need specialist advice to be able to deal with transferring assets in a way that's not going to trigger capital gains, but is going to give them the inheritance tax relief that they are going to need, or will face the 40% tax charge on death. So I am a lawyer. I specialise in tax planning and structures. I've got 30 years of experience in senior tax advisory roles, and those are my contact details. We have monthly tax planning and tax updates, and you can subscribe to the YouTube channel. Now we can deal with any questions that people have got as a result of that quick update on inheritance tax.
Thank you very much, Hazel. That's very useful. If I can take the opportunity to just add a few points whilst we wait for some questions. I get a lot of inquiries about. We work with about 143 or something like that accountants and solicitors who regularly pass on inheritance tax planning clients to us, and a lot of those questions are the referrals are from for clients who have a couple of properties, starting from a couple of million, going up to a couple of 100 million, Uh, the common theme is that people seem to be under the perception that when you incorporate, when you transfer your properties into a limited company, you somehow magically your inheritance tax will go away, and that's a common misconception. When you incorporate, you inherit the value of the shares that you have. And some people think that you gift the shares, you'll be fine, but you cannot gift the shares after incorporation because you trigger capital gains tax. So, and then you trigger the 7-year clock as well, the inheritance tax if you die. So it's very, very misconception, and people get confused by this. Once Hazel correctly pointed out on the wills, mirror wills can bunch an estate. So where we have mirror will, husband passes, everything leaves to the wife, he leaves everything to the wife, etc., and vice versa. That can be counterproductive. I think that's a time bomb, and a lot of people there are a lot of people who come to me saying to me that we have already resolved our tax planning. We don't need to engage a tax advisor. I say, how did you do that? They say, well, we went to a solicitor, we paid £250 for a will, and we're all sorted. And I say, well, congratulations, that's very good, because that's not what you want. That's not you've been missold tax planning if you think that that's going to solve all your problems. So will is good, but effective use of will, especially using this when you've got time, you shouldn't be relying on a mirror will. That when I die, everything will go to my wife, or my wife dies, everything will come to me. That if you've got enough time, then that's the last thing you should be doing. Yes, if you're running out of time and then there's somebody to pass away imminently, then the mirror will is a good idea, to leave everything to the surviving spouse. The surviving spouse can then do tax planning. You need to allow for tax, which is potentially exempt transfers. If you are making gifts, then you need to allow 7 years. So if the person who's making the gift should be in good health to survive that 7-year clock, if not, then what we do is essentially transfer the assets to the spouse who has a higher life expectancy. I'll give you an example. We get cases, for example, we had a couple of cases where one of the spouses has cancer, and we've been asked to do the tax planning for that family. So what we would do is the person who's got the cancer would transfer all their assets, properties to their spouse, and the spouse can then make the gifts in a tax efficient manner, which Hazel described. There are different structures that we could use. You cannot get the person who's got cancer and has got stage 2 or stage 3 or stage 4 cancer to be making gifts, because they're not going to survive the 7 years. Very, very important. And the 7-year clock is also, as you go further down in the 7-year clock, you have something called taper relief. So the tax that applies, the 40% gets gradually reduced. One thing I say to my clients, and a lot of people come to us for tax planning, is don't procrastinate. Procrastination can be very, very costly. And on the face of it, inheritance tax planning is not dead urgent. But I see a lot of very, very desperate families who've lost their loved ones, and that's one loss. And the second loss is not being prepared for the inheritance tax, which is effectively 40% of the estate. We're looking at one estate at the moment where they've got to pay about £6 million in inheritance tax. They don't have £6 million. They will have to spend a lot of time to raise that £6 million. So that's something that procrastination can be very costly. Get a consultation, speak to somebody, speak to an advisor, look at your options, and then you can decide whether you want to pay 40% of your estate to the Chancellor or not. And if you don't want to pay it, then you better do something about it. As I said, we get a lot of referrals from solicitors, and the same thing the solicitors would say to their clients: you've got to take specialist advice. This is beyond a will, so you should not be relying on a will. You must take specialist advice, and this is what we try to do to help our clients. So we've got a couple of questions. Hazel, do you want to take the first question?
Yes, so somebody's asked, will a will cover the transfer of property if the property was bought through a limited company and the property is a buy-to-let? I mean, a will covers anything that you own, that you either you specifically mention or it falls into what we call residue. So you can deal with any kind of asset through a will. But the property value will be reflected in the company shares, and the company shares will be taxed in your estate if you're dealing with it through will, rather than having done sort of lifetime planning in anticipation of your death within sort of that next decade.
Yeah, I guess it's if it's owned by the company, it's not owned by you as such. So the will deal with the shares in the company, but not the property in the company, because the property is owned by the limited company, which is a separate legal entity. We've got a couple of more questions on trusts. I've been asked by somebody to expand on trusts. Why are the trusts? Because people seem to be thinking that trusts are very good vehicles. Trusts were very good, and Hazel has done more than I have, but we have advised a lot of clients on setting up a trust. But for serious tax advisory clients, trusts are no go at the moment. In fact, we haven't set up trusts for good 10, 12 years, and Hazel would say the same. In the early 2000s, late 90s, we did set up quite a lot of trusts, but these days we seem to be making more money, essentially, from getting people out of trusts. Hazel described that initially when you set up a trust now that the rules are very prohibitive. And Gordon Brown had I think, if I can recall correctly, he always had a vendetta against trusts. So now you set up a trust. If the value of the asset that's going into the trust is more than 325,000, you've got to pay a lifetime charge of 20%. The trust pays income tax. That's the first hurdle. The second one is the trust pays income tax at 45%. Although you can get credit, but you might not be able to get credit if everybody else is a higher rate taxpayer. So it's not a good vehicle. But even if you get a credit, but I've got a client who's got 13 properties in the trust, and for him to keep up with the payments on account every 6 months, he's come to me on his knees. He said, Jamal, you were right 10 years ago. I should not have set up a trust. This is costing me. And now he's got to pay the 10-year charge. 10-year anniversary charge is around just 6% or 5% of the value of the properties. If you want to get the properties out of a trust, there's an exit charge. It's very, very expensive. So trusts were very good, but they're not good anymore. Therefore, we advise clients that, in fact, I must say, I have a family friend. He contacted me 2 weeks ago. He said, Jamal, I've been meaning to talk to you for 2 years. Somebody came, we had a pensions guy who came into our house, and then he sold me 2 trusts. Can you have a look? They paid about £5,000–6,000 for these 2 trusts. I had a look at the papers, and they were not what the paper they were written on. There was nothing. They just opened a bank account, put £1 in it, and called it a will trust. The will trust doesn't do anything. Will trust means that it will be set up once you've paid your tax, essentially. So there's no tax planning involved in a will trust. Very, very careful. So there are a lot of people still selling trusts out there. And these people are maybe IFAs or whatever they are, but they're not. If you look at it from a serious tax planning perspective, they don't do anything. Yes, you can, maybe we're setting up trusts in Scotland and other parts of Wales where the property value is 40, 50, 60,000 pounds. You can put a couple of properties and still not breach the 325,000 limit. But then you've got to consider the income taxation, which is 45%. I've got another question. We've got a question from Michael as well. It's about one of our contacts says, one of our accountants has sent me this message. His client has 7 properties and the total estate is worth about £3.5–4 million. What should he do? That's a very, very common scenario that we have. In fact, we spoke to somebody yesterday and the day before last week as well. A landlord cannot rely on exemptions, which Hazel pointed out, business property relief exemptions. So landlords have to do serious planning. You have to do a special structure. Otherwise, you should be prepared to pay the inheritance tax at 40% on the values of the property at the time of your death. For example, right now it's £4 million. At the time somebody passes, the value might be £7 million. So you will be paying 40% at £7 million. So you've got to engage as soon as you can a tax advisor. You can speak to Hazel's telephone number, you can speak to me, or get specialist advice. There are different methods that are available, different structures that we can use. Depending on your family circumstances, you might want to retain the income, but pass on the assets, and so that you can benefit from the assets for as long as you're alive. Very, very important structures. Protect the family assets, protection for minor children. So these are some of the things that you need to consider. Hazel, do you want to take the question from the next question?
Michael asks about a client looking for advice on transferring business premises and a flat to children, and the properties have a mortgage, and he's saying he's looking the best way to transfer, taking into account inheritance tax, stamp duty, land tax, and capital gains tax. As Jamal says, this is a sort of quite a common scenario. So because the properties are mortgaged, if the children take on the mortgage, then that's the same as sort of paying for the properties. And so they would have to pay stamp duty, land tax. Now, at the moment, that's not going to be much of a problem on that value, because 365,000 is going to be under the new £500,000 sort of tax-free bonanza that the Chancellor has organised. But, normally that would be generating stamp duty, land tax charges. And certainly there would be capital gains tax on the gift, unless you did some planning. So we have a structure that we use for that kind of thing, where you can use a partnership where you can transfer properties into the partnership as a first step, at the very least, which allows you to the contribution of the properties to the partnership ought not to generate a capital gains tax charge. And then there are ways in which you can transfer the value held in the partnership to the children in a way that doesn't trigger a capital gains tax charge. And then all that the parent would have to do would be to survive 7 years from the date of that transfer, to avoid the inheritance tax. And certainly one of the things you can do with a transfer like that, depending on the values involved, whether it's cost effective, is you can take term life insurance to cover the value of the pet, so that even if you do die within the 7 years of the transfer, the insurance will pay for the inheritance tax bill. So it essentially sort of renders the whole process even more tax efficient. And because it's what we call it's a 7-year policy rather than full life insurance, and depending on the health and age of the people who are making the transfer, that can be very, very reasonably priced. I don't know if Jamal wants to sort of say something about that.
Sorry, I'm on mute. No, I think you've hit it correctly. It's absolutely you've got to. You do not want to be the person started the transaction or completed the transaction, and then you contact Hazel to say, "I've done this. What should I do now?" All Hazel's going to say is, "You've got to pay capital gains tax, and you've got to pay stamp duty." So there are, take advice beforehand and structure it very carefully. This is how we always do it. But I think Michael has requested that we contact him. Michael, you can contact Hazel. It's h.johnson@churchill-tax-advisors.co.uk, and Hazel will send you an email shortly after this. Excellent. Well, I think we've covered almost everything, and there will be a recording available of this webinar on our website and our YouTube channel. I will send it out to most of my contacts, and thank you very much for everybody for joining. And we'll see you again with Hazel and myself in about 4 weeks' time. But we've got our tax investigations team's next webinar due about 2 weeks' time. Thank you very much.
Okay then. Bye-bye.
Bye.